Okay guys, hi. So this is the next stage of this chapter. Now here's the thing, I keep highlighting this. Please just religiously go through this chapter. It's almost a boring theory, but it's important because once you come to do the questions, they become very light and very straightforward. So I'm just almost trying to push the theory or the issues. Remember, we're talking about trying to consolidate a parent and a subsidiary. And like I mentioned, these become, once a parent acquires a subsidiary, what we're really looking at is two organizations that just simply have, the subsidiary just becomes a department, like any department, marketing or HR, within the parent. So we cannot recognize intra-group trading. There's just no space for it. It's just not possible because the definition, right, of trade is trade with outside third parties. So anything would just show inflation. Your revenue, any revenue with intra-group would just be inflation. So we just have to deduct those, remove those, and that the evidence of that intra-group trading in terms of what is owed and what is outstanding is recognized within the current accounts between the parent and the subsidiary. So they'll keep a separate current account to show the relationship of what's going on between them. It doesn't really matter, whatever it is, loans, if one parent, if you like, if one parent, so if parent gives a loan, debit asset, credit bank, so parent is showing a loan of 100 million, and 100 million has left their bank, and then subsidiary receives the loan, debit bank. You can see why it doesn't matter when we deal with the bank. We just leave that alone, and then they'll recognize a liability of 100 million. What we're saying is these don't exist, because what's going to happen is we're going to add our bank together when we consolidate, and that cancels out, as you can imagine. But of course, there is no real asset. You didn't lend money to an outside party, you lent it to yourself. So ultimately the real journal to do, well, for us, all we do is we just credit asset and debit liability, really. And that's enough, actually, I can imagine, if you're really preparing the thing, as long as you add these together. I just think it depends on the processes wherever you work, or wherever you are. They might actually want to journal out this and journal that out, and that's fine, still the same thing. But this is enough, because so when we talk about cancelling out, you will see people just do this right on the actual statement of financial position. Just do that, deduct 100 from assets, and under liabilities deduct 100 from liabilities. But I'm showing you the journals so you can actually see exactly what's going on. These cannot exist. But before we can do this, we typically have we'll see that. So let's just talk about it. So dividends and loan interest cannot, they aren't income, they aren't external. We'll come and talk about unrealized profit on sales of inventory and unrealized profit on non-current assets. So we'll see those. The key point is that you have parents selling stock to each other, and there's some profit, so to speak, sitting in inventory. So here we are, a receivable, exactly what I just said, and payable will arise in both due to trade on credit. These are cancelled out on consolidation. And then we sometimes have this interesting scenario where the current accounts may not agree because someone has sent a check, if you like. So someone, if you like, has debited its current liabilities with an amount and credited bank, and someone is yet to debit its bank and credit its trade receivable, or its current account, so to speak. So this hasn't happened yet. This is the problem. The problem is that this hasn't happened in whoever's receiving the money, but this has happened. So therefore, the current accounts will not agree. So the argument has to be that we need to update this problem. So complete the journal to update, if you like, the what we refer to as the cash in transit, and then you will see that the current accounts agree. So 2 steps there. In order to eliminate a current account, it'd be wonderful if there was no cash in transit, we'd just eliminate it, but sometimes it might not agree, and so the first thing you have to do is put that journal through to complete that, complete that transfer. Then you can eliminate the accounts. I've written, let's work on example 4. Okay, I actually have it written. Here we have, it's in your textbook. Please, example 4. And for homework, please do TYU 5. Yeah, just do these questions every day, and you'll just get used to it. You'll see that you will gain, you get comfortable. You'll get comfortable with it. Right, okay, what are we talking about? What am I talking about here? Let's see. So we have a scenario where plant's record shows 6,000 owing to shrub, but shrub, so basically plant has sent some money to shrub. Plant has debited its current liabilities. If you like, we can see it is 2,000 in credit bank. That's what plant has done. Plant has sent this out, but shrub has not received the check. Or, I mean, I'm going to assume this definitely cannot be online. So definitely shrub has not received this. So shrub is still showing current, if you like, showing a current asset of 8. So what am I asking you to do? I'm asking you to update this debit bank 2,000, credit current asset 2,000. So take away this from here. Right, and that's what I'm asking you to do. So what am I saying? Why? It must be the plant must have sent a check to shrub of 2,000 that shrub has not yet received. So this is what shrub did. Sorry, this is what plant did. Being payment to shrub. That's the journal entry. Being payment to shrub for internal whatever trade. Yeah, and therefore, so we complete the transaction in shrub, carrying out an update in, if you like, in the person receiving the money. Debit bank, credit trade receivables, or internal. Now both the current accounts will match. And you mustn't forget, after all this hard work, now you can eliminate the current accounts because you can only eliminate two things that are equal, right? Debit current assets and credit trade receivables. Yes. So that's kind of what's going on there. That's kind of going on there. Let's just look at. Let me just show you what the picture looks like, because I want to do this in bits. When I say in bits, I'm going to go into the next section, but I want to finish this section first. So this was the actual question here, illustration 4, and you can see here that you have other trade receivables, external ones, of course, but it's the internal one we're interested in. So. Excuse me, sorry, forgive me. What we now have here is that you can see here, look at this. So first of all, we had that cash adjustment, 2 coming into bank and 2 coming out of trade receivable first, and then we got rid of the intercompany -6, if you like, and -6 over here as well. Right? Good. What I want to do here in the last 2 minutes is just to do this question of goodwill. Every time I talk about this idea that sometimes you might get asked this strange type of thing, Plant uses the proportion of net asset method, so it doesn't use the fair value method. So let me just do it here. I mean, I'll do it over. We're going to keep these questions. We'll do over and over again. So I'm never really too, there's no point bombarding with all the quirks. But this is a minor quirk. So here we have a scenario where the parent has paid 180. So I'm just going to go to here. I'm just going to, why not create a new, oops, sorry. I was going to just introduce a new slide. So here, the parent has paid 180. That's the parent, 80%, I believe. That's the parent. And usually you get given a 20% fair value, but this time you're not given. So what they're telling you to do is to look at working 2. So you got, well, sorry, you bought 80,000. Yeah, you bought 80,000 shares, and that's 100,000 shares. So you bought 80%, and you bought the 80,000 when the reserves were 30,000. The premium was 30,000, and retained earnings was 5. So we know that working 2 at acquisition is 100, 30, and 5, right? They tell us. So I'm just going to go back here. So working 2, share capital, 100, share premium, 30, retained earnings, 5. I'm just going to quickly check just to make sure there are no fair value issues in terms of revaluation. I doubt it. They would want to mix up questions in the text. Okay, great. So there's nothing along those lines. So what do we have here? We now have a total of 135. So because you're not given a fair value, they're just telling you this is the value of this business. There's no fair value issue for the non-controlling interest. They have 20% of it, so you take 20% of this 135. That's the value. That's the proportion of net assets. Oh, these are the net assets. This is the value of the business times 135, which is 27. So that's the value of that. So this is how. So this goodwill, all this goodwill belongs to the parent, as you can imagine, because you had no fair value here. You know, you just own your own share of the net assets, the physical assets, so to speak. And so now that's your 20%, and now I can take away the 135, which is the 100%. So that's what you paid, 180. That's the 20%. And here we have 7, we have 0, we have 207. So goodwill is 7, 2, 9 minus 3, 6. Goodwill is 62 million. And then again, as usual, just read the question for any impairment or anything along those lines. Cool, great stuff. Okay, great. I'll see you in the next video. So in this video, we have fundamentally looked at how we eliminate intercompany loans or intercompany trade, right? In terms of current accounts, assets and liabilities resulting in statement of financial position as a result of trading and dealing with cash in transit to make sure we do that first. Cool, great stuff. See you in the next video.